Welcome back to the Investing Markets and Money podcast. And today we're talking about the solar energy industry. And joining us on the podcast, we have Ross Driver, who is a co-manager of the Foresight Solar Fund, and is going to be telling us a little bit more about the fund itself, but also giving us some of his views on where we are with solar technology. So welcome to the podcast, Ross.
Hi, Stuart. Pleasure to be with you.
Just quickly to start off with, Foresight Solar Fund. Can you give us a quick overview of that fund? It's a listed fund, but can you give us a bit more background on the strategy and what it sets out to do?
At Foresight Solar, the fund has been around, it's in its 12th year now, listed on the stock exchange back in 2013. Originally sort of set up to invest in operational solar vehicles, started off here in the UK, and is invested in built up a portfolio of 50 solar assets here in the UK, and then diversified into other international geographies as well, including Spain and Australia. So we currently manage around 1 gigawatt of solar and BESS projects across those jurisdictions. We've got 61 assets in total and about a 1 gigawatt development pipeline. So I think the change over the years has been from sort of primarily investing in sort of operational steady state to moving sort of up the or moving up the risk curve a little bit in terms of building out our own projects, and we're now in the process of developing our own projects as well. So sort of bringing them through right from the early stage of the sort of creation of those projects. So what we're targeting at the moment is about a 2 to 3 gigawatt pipeline. So this is like three times the size of the current fund at the moment, to capitalise on the momentum in renewables build out, predominantly across European markets, and to look into looking to deliver good yield for investors, but along with growth for shareholder returns as well. The fund is managed by Foresight Group, who I work for. Got an international presence with boots on the ground in all of these locations. We've got about 5 offices in Europe and a couple in Australia as well, and cover all those markets. The fund itself, yes, it's been around for 11 years now. It's an investment trust and listed. It's a FTSE 250. Operates within those markets. We have non-executive boards who've been with the fund. Given that we've come up to into the 12th year, we're in the process of rotating directors of that, and we've recently brought on a couple of very experienced directors, a gentleman called Tony Roper, who launched Tickle and more latterly was involved in raising Trig, another fund, and Paul Masterton, who is at 3i Infrastructure as well. So we've got some non-executive directors who push forward the direction of the company, who we report to and manage the fund on their behalf. We've got some deep sector expertise there as well.
Just quickly, because this is obviously a fund that is designed for investors who want direct exposure to the solar energy industry. What does a typical asset? You mentioned assets in the fund. What does a typical asset in the fund look like?
Typical one in sort of our UK portfolio would probably be a solar farm that's probably about 20 to 30 megawatts in size, that's the size of several football pitches, to put it into perspective, and they are large scale ground mounted sites. I think that would be the average sort of size of projects from the legacy portfolio that were constructed in around the 2010 to 2015 time frame. It's fair to say that the projects are getting bigger and bigger than that now, in terms of not just the UK but other markets as well. So we're looking at projects coming through in our development portfolio that we've got in Spain at the moment that can be anywhere from 50 megawatts up to 200. So multiple sizes of that as well. So and that's the end game to getting to those fully operational solar farms that are sat there connected to the grid and generating electricity when the sun is shining. Doesn't need to be sort of basking in glorious sunshine like you get in the south of Spain all the time. Even a slightly overcast day like today will do that. But that's but in terms of what we're getting into. We are now at the stage of working with developers to sort of bring those projects through from the basic concepts in terms of going out, acquiring land, acquiring grid, to put together a project that gets to what we'd say construction ready, and bringing that through and building the project out ourselves as well.
And the fund has a income objective and a growth objective. Can you shed some light on how you balance that? How you get income and growth for investors from these assets?
Absolutely. So I think it's fair to say for the first 10 years of the fund, and we were one of the first generation of renewable energy investment trusts out there. So these are bringing the ability to invest in this asset class out into public markets. So it's available for large institutional buyers, but also retail buyers. Anyone can find us through the platforms and buy the stock there. I think there was half a dozen of us who listed around the same time in the early days and back in 2013. And it's fair to say that at that point in time, a lot of the focus was on generating yield. And a lot of the funds in the peer group were all sort of looked at as yield codes, because at the time, if listeners remember back to those times, we're going back, 12 years now, the interest rates were falling, beginning to fall at that point. And by sort of 2015-16, we had some of the lowest interest rates that there's been for many, many years. And this is all quite relevant given where we are now in the cycle. And actually, if you take inflation into consideration, those interest rates were actually negative. By the time you take off the inflation, and you're left with a sort of negative interest rate on that. The yield on these vehicles, I'm talking about the sector in general, it was giving off a yield sort of inflation adjusted of about 4 to 6% a year. So you're there and you say that actually the real interest rates, once you've taken off inflation, were negative, maybe about sort of 1 or 2%, and then you're getting a yield above that off these vehicles of 4 to 6. There's a very good spread in there that's, I think, very attractive in terms of what you can get versus fixed income projects. So that has been the mainstay, I think, for the first up until about 2020. In terms of they are very focused on paying out stable and well covered dividends, and that's what FSFL has done since its outset. The first dividend was about 6 pence, off around the circa 100 pence launch price back then, and that has grown 30% up to, we're now giving off an 8 pence per year dividend. The difference is what's happened in the base rate and the gilt rate since obviously we've had the pandemic, the after effects of that, and the surge in inflation and energy prices. So I'm sure everybody is very aware from their own costs, their own mortgage costs, that the cost of debt has gone up significantly and the base rate has gone up significantly. And what that's done for not just FSFL but the sector, I think a lot of the investment trust sector and alternatives sector has sort of narrowed that gap between the yield that is offered versus gilts as well. So I think the our fund was already in this sort of transition in terms of looking ahead, in terms of like saying, well, that spread in terms of yield and very high quality yield and well covered dividends that the funds can give off has narrowed. Obviously, the investor's going to need something more in there in terms of to see the attraction versus other fixed income products. And we have the ability to deliver on that and growth, because the yield is predominantly given off by the dividends are predominantly covered by the operational projects. Once these projects are set up and run, and I'm not going to make out that it's just as easy as sticking some solar panels in a field and leaving them and hoping for the best. There's some serious engineering that goes on to make sure that they're operating and make sure that they're operating well, which we have whole teams for. That you can, if they are well maintained and looked after, they will generate the cash flows to help pay out the yield part. So where do you add in the growth element of that? Well, given our knowledge of actually going earlier up the food chain, if you like, in a way, to constructing projects, de-risking them, and actually going to the earlier stage of starting to develop projects from scratch, that is where you can add the value. And I quite often liken this in terms of those where you, as an experienced infrastructure manager, what you're doing is de-risking at each point along the step along the process and adding additional value to the projects. A bit of an anecdote in the way to think about this: if you've got a piece of land and it may have a certain level of value, if you get planning permission for that land to build, say, a house, a factory, or something like that, the value of that land increases. So that's a similar. There's a good comparison there to how we develop and add value to our projects. So we would take a site and look to get the planning permission to actually develop a site on a piece of land. I think at that point you then take forward and you build out the project. So going back to the land example, you build a house on that piece of land, and therefore you then have an asset that is far more valuable than it was before. And once that is up, working, and and actually ready in the basis of a house, it's ready to move into if a builder had done it, and then they can then sell that on to value, and that's how they create the value themselves. I think for us getting to a point of building out an asset that then has those long dated cash flows coming off it, that is where you add value at every stage. So every stage of that process is creating a more valuable asset that can generate income for the fund or could be traded and sold to somebody else in the future. And that's the basics how you're creating that level of growth out of the asset class.
And do you, with some of these assets that you have, is there the plan to actually sell them on once it's a mature solar farm, it's doing well, there's no scope for further expansion? Do you then look to sell it on to other buyers to create more capital for the fund?
Yes, and that's more of the plan of where we're going now in terms of trading. I think when the fund was more focused on sort of yield alone, it's fair to say these are very long term assets. These have useful lives if they are well maintained. They have useful lives in the sort of 30 to 40 year time frame as well, and they have long term contracted revenues as well. I'm not saying that there wouldn't be you wouldn't be changing parts of it out over the years, but actually in terms of the panels themselves, can last for up to 30 to 40 years. We're looking at in terms of both technologies, not just solar but battery storage as well. And this is where we come back to this point of the large. We're looking to grow a large pipeline of up to 2 to 3 gigawatts. So that's sort of 2 to 3 times the size of the fund already. And we'll look along that. There are some of these projects we would choose to, if we've got the capital available to fund, to build them out and add that value to the fund. The other way is going back to the example of, yes, you develop, build a house, and then get it to operation, and then sell it on to a third party to actually to operate it. We could sell these projects at the point that we've got them construction ready. There is a lot of appetite out there, or we could sell them once they're operational with a true proven track record. So it'd be a balance of the two, building them out in order to continue to secure the yield for the fund, and then trading to cash in on some capital growth as well.
And you mentioned battery storage there. Obviously, that's an important component for things like wind power, solar energy, because at the end of the day, the sun doesn't shine in the UK 365 days a year. So some of this energy, you want to be able to store it as well. So are you actually investing in that battery infrastructure in addition?
Yeah, so we're investing in two ways on a standalone basis, and we've got three projects that we're one of which we're about to finalise kind of construction completion on. That's a standalone battery, so it would sort of trade more in the markets and the balancing. But I think most of the new solar projects, especially the larger ones, you're going to be looking at co-locating batteries within them as well. So that means they are sort of part of the project along with the solar. And to your point, in the uh, the point around the batteries and what that is doing, the energy transition itself, be it solar, be it wind, is moving. There will be a lot more intermittent generation coming in, and solar not just we can talk about the UK and how many, especially over the last year, how many sunny days or not or lack of them that we've had. But clearly, solar's never going to generate at night either. So the profiles of these are, we expect obviously that the solar is only generating during those daytime peaks during the daytime, and there will be particular peaks during the day. But there is the possibility then to charge up the batteries or other forms of long duration storage, and especially when the power prices are low. So what we're going to see more of as renewable generation starts to proliferate throughout the system is probably those days where you get a really bright sunny day and it's windy at the same time. And you're going to have a lot, if you assume that the baseload power, the nuclear and other is on, you're going to have a lot of generation coming into the grid, which will drop, supply and demand will drop the price of energy. At that time, that's the perfect time for these batteries to then charge up and then sell them back into the grid at the peaks of the day. So at the shoulders, when everybody's getting ready in the morning, when everybody comes home from work at the end and puts the kettle and the oven on. So it's balancing the system in a more to phase it out as not just the UK, but I think most countries in the world are starting to move from a sort of very centralized system where you have large coal power stations and others to a decentralized system where you have a much broader mix of energy across country. So that's where both forms of those technologies will play.
And I've been a board level advisor to a biogas fund for over a decade now. And one of the things we found is that biogas, although it's great, can be great technology, planning restrictions have always been an issue, certainly as far as the UK is concerned, in the rollout of that as an alternative energy source in Britain. Is that something you've encountered as well with solar farms in the UK and the other markets that you're operating in?
Yes, I think unlocking the planning system is absolutely key to this. It boosts investor confidence in the viability of the projects. We know now that Labour's pushing through their planning and infrastructure bill. There's the clean energy plan where it ups the threshold for large projects to about 100 megawatts. And what we're seeing is a lot more push by this government seeking to hire more planning officers, making the process more straightforward to sort of push these projects through. But these reforms will take quite a long time to take a while for those changes to bake in. But it sends positive signals in terms of the direction in the medium to long term. So I think it's one area where yes, there is more to be done there. But it's not stopping it even at the moment. And even under the previous administration, I think there have been attempts to sort of simplify the planning process for these. There is a consensus view around looking to meet the energy transition targets, and especially those that we've got for 2030. This will mean a lot more. I mean, still at least a sort of tripling of solar to deliver in the UK in order to meet those 2030 targets from where things have got to at the moment. So that is going to need the planning system and the grid as well, which is the other side of it, which is a large challenge. That said, we don't see a shortage of projects that are coming through from the developers that we work with as well. So it's making sure that you're working with the people who have the right expertise in taking these projects through. But anything that's going to what we've been delivering, what we've been rolling out in this, particularly in the UK at the moment, same for many other developed markets, it's going to need to be 2, 3, 4 times that in order to hit the targets. So there's going to need to be help there on planning reform and the grid as well.
And are you seeing or anticipating any further government support for the solar industry that you think might benefit the fund?
I think the direction of travel so far has been positive. So you had Ed Miliband sign off a number of large projects within his first week in office, large solar projects. I think that sort of set out a statement of intent, really, in terms of what his plans were for the sector and the government in general. I think there are what we're assuming is that there will be further support in the sort of the support mechanisms for solar now, not just solar but wind and offshore wind as well, which comes through the CFD mechanism, the contracts for difference. So there is that as well. There is the broader subjects of REMA, electricity market arrangement reform. So that's a bit of an unanswered question at the moment in terms of which direction that could go in. And our understanding is the government's taking their time to consider that and the next steps. And the grid is also looking to, but everything seems to be pushing towards the positive sign of it. Everything is pushing towards trying to meet these 2030 targets. Because the one thing I'd say is if you go for a complete revolution in the way that the grid operates, that could take many, many years to enforce. And we're at the beginning of 2025 now. So if you're generous, we've got 6 years, including this, to sort of get there by 2030. If you rip up the whole way that the grid operates and starts again, it's going to be very challenging to meet those targets. So I'd expect more for sort of an evolution and a changing of the grid. There is absolutely reform that's going to need to be made to the way that the grid operates because we are going from, as I said, this very centralized system of say few dozen very, very large power stations operating the legacy coal system to a really decentralized thing of hundreds, if not thousands, of renewable energy projects and batteries that are coming in to help power the grid. Now, if we look at that into the UK is by no means alone in terms of looking at those challenges. This is a global challenge. But I guess it's how that is addressed and how government is looking to push toward that reform. That's going to be the interesting side. We've seen positive movements by this administration.
You've talked already about how the kind of clean energy industry is very much more decentralized compared with the old fossil fuels industry. When you look at the solar power, I mean, and look ahead, say 10 years, what how does that stack up in terms of its overall contribution to energy appetite versus other power sources? I mean, what sort of percentage do you think solar will be contributing in 10 years from now?
I think solar's the actual slides on this. I think from the NISO presentation. So solar will be an important part of the mix, along with wind, along with other. I think especially for the UK. I mean, it goes market by market, of course, but if we look at the UK for a start, I think the plan is to obviously maintain a level of base load generation there through the nuclear fleet as well, which will provide that steady base load. And the plans for if solar is sort of trebling or quadrupling in terms of its generation, it's probably down at the sort of 5 to 10% at the moment, but could double from that in terms of what its output and the expectations of the grid are. There's also expected to be obviously a large growth in offshore wind and onshore wind making a comeback as well. You will have the balancing technologies of batteries, and also there is the development of interconnectors into other locations. So our wider group is currently developing an interconnector between the UK and Ireland at the moment, so countries are able to share those supplies and demand with each other. But it will, looking at it, although sort of leading a solar fund, and we are investing in batteries as well, it's going to take a balanced grid of multiple. We shouldn't be putting all our eggs in one basket. I mean, I think there was a really great example because you can get an app for your phone that will show you at any point in time what is being delivered on the grid at the moment. And there was a great example. We were looking at this. I was at a conference on Wednesday and chatting with a chap, and we were looking at this app. And solar was actually providing about. If you can imagine, it was Wednesday. It was quite a dark and dismal day, but solar was still providing in the depths of winter about 4% of the national output at the time. Obviously, at the moment, we're still very reliant on gas in these downtimes. But that's, if you think about it, it doesn't sound like much. But for the depths of winter, when the days are short and it's pretty grey, that's quite interesting. It was actually 3 times the amount that was being generated by wind because it was such a still day as well. So you are going to need this balance between multiple different technologies.
And do you see any? I mean, we mentioned planning already on this discussion, but do you see any other constraints that could curtail the expansion of solar energy? I mean, I'm thinking, for example, here with things like the silver price, because I was on a panel at the Resourcing Tomorrow conference in December, and they were talking there about how silver is being consumed by the solar industry, and that's in turn pushing the price up and could make it more expensive to actually build new solar farms. I mean, are there any other potential roadblocks like that you worry about?
Say at the moment, and I know what you mean in terms of silver, in terms of the overall build of the panels and everything for sites. But actually, over the last decade, with a bit of a blip during the pandemic, the cost of solar and the panels has just been falling and falling and falling in terms of that. And this is alongside, and the panels are becoming more efficient as well. So it is one of the cheapest forms of electricity that you can get out there. And there is also the point. There's an economics point of that as well, because I think there's quite an oversupply of panels out there in the market at the moment. That they're almost getting to the point that they're actually probably selling for less than the production cost at the moment. There's a glut and an oversupply out there, which is more of an economics point. But the increases in efficiency and productivity from them as well, and the learning and the development that is going on. I mean, solar panels today already versus the sites that we have that are coming up to 10 to 15 years old are probably multiples more efficient than the new panels and new solar farms that could be able to be multiple times more efficient than that. So cost of the panels I don't see as a particular concern just because it's so much cheaper than other forms of generation. And actually, although as I say, you do need to maintain them over the years, there's less moving parts in a solar farm. So as long as you're looking after the grid infrastructure, you're looking after those panels, they're kept clean and free from distraction. they do run quite well. I think part of it will be supply and economics. I think coming into, gosh, we couldn't get through this podcast without maybe mentioning tariffs, given the change of the administration in the UK. So I'd say that there's probably, rather than cost of raw materials, because there is the opportunity to pivot into. You can take silver as an example, but there's potential to pivot into other materials in terms of that. I think anything that blocks barriers to global trade may have more of an impact on this, and especially hiding from the fact that the most prolific panel manufacturers in the world are based in China at the moment, even though they are themselves sort of diversifying and moving out into other markets. And clearly, you have the UK and the US that want to push forward their own domestic sort of solar panel production as well. So I think economic moves are going to be more of an impact than necessarily the technology itself.
And you've mentioned electricity prices. Obviously, they were in the news a few years ago when prices were extremely high. They don't seem to stay out of the news very often. How important are those prices to the overall profitability of the fund? And how do you hedge some of the risk out when, if those prices were to fall? I mean, can keep it consistently profitable?
No, absolutely, and I think yeah, it's a very important to the fund because the whole premise of our fund is to make sure it's there to pay out the dividends and deliver the capital growth for investors. And so I think if we the best example of this is to wind back to sort of actually about 7 or 8 years ago. So this is before the pandemic and what the average prices were there. The long term sort of real average price hasn't changed that much from the forecasters, despite all the blips up and down, that it comes down to about a long term rate of about £40 to £50 a megawatt hour in sort of in real terms. That's where the forecast has been. The It's not surprising. What we do in terms of looking at this, we look forward, and many generators do this as well. You look to sell forward your power for up to years ahead and to lock in at prices. Now, we know what sort of power prices we need in order to cover our dividend and pay out to producers. And we'd say we are infrastructure professionals. We are not energy traders. So therefore, we look to lock into those prices that we know will give us good dividend cover, and we to give us that buffer and for unforeseen circumstances, we look to forward sell a lot of that energy up to sort of 3 to 5 years ahead, and we'll always be building and rolling forward our positions. And the pandemic was an absolute prime example of that because during that point, in about when the pandemic kicked off at around 2020, if we hadn't have forward sold some of that power prices at good prices, which around the time were probably about £60 to £70 a megawatt hour, unsurprisingly, the power price dropped to the floor because industry was shutting down, everybody was working from home, and a lot of it's things like heavy industry. So the power price then dropped down to about at the lowest about £20 to £25 a megawatt hour, and at that point it's unsustainable for not I think not just for us but for many generators because of the you think why is that the case if you've built these projects and then actually the running costs are relatively low for them. But it's because it's like all infrastructure. There is such a big investment up front, and all of these sites, whether it's solar, whether it's wind, whether it's anything else, whether it's a traditional power station, it's capital intensive. It requires a huge amount of investment up front that is then really paid back over a sort of 20 to 30 year period and then make the returns. So there is a minimum that minimum level, and for us it's probably around the sort of £50 to £60 a megawatt hour level that you need to recover in order to make the returns for the portfolio. So looking at it, that helped prove the case then because we already hedged a lot of our power prices and therefore we were covered. So actually we had forward sold, we had locked in contracts for those power prices. So as long as our sites were delivering and generating, we have these contracts in place. I think the biggest risk there for you is in those times of absolute crunch like that, or market sort of almost black swan market events that you're outside of your control. It's not that we are not worried that we don't have the contracts in place. It's what's the credit worthy of the counterparty in those? Are they at risk of going under because they're having to pay out these contracted prices, and then you've got a massive amount of uncertainty in the world. So I think it's important at the same time to have a balanced and a mixed range of people who are buying the power off you that have got a good credit rated, and it's distributed, so you're not overly reliant on one single person. So having those power prices fixed and being able to continue generating got us through the pandemic. I mean, then as we came out of that and we had the Russian invasion of Ukraine, you have the exact opposite. So I think where we were in sort of as the pandemic was coming to a close was thinking, well, look, we're on the floor, industry's starting to open back up. As I say, we're not energy traders, but you look at it and you think, well, the risk is all to the upside here. So at that point, we probably left more of our portfolio unhedged to look to take advantage of what we saw as rising power prices and getting back to a more normalised basis. I would question anybody at that point before Ukraine who could have foreseen that power prices would have gone up to 200, 300, 400, or even 500 pounds a megawatt hour prior to knowing about the Russian invasion of Ukraine. And that was the complete flip side, that power prices got to a totally unsustainable level at that point as well. So I think that the lesson out of that and where it comes back to is that as infrastructure investors who are in this, and it comes back to that, we're in it for the long term 20, 30, even 40-year plays in these type of things. We would trade away a lot of the upside for the downside protection, really, in terms of that. I don't think if you go through the chance of, well, could you get through the pandemic if you traded away the upside for those spikes that are one-offs as well? Because what you want to, the most important thing is to be able to deliver out the returns to your investors. You'd like to be able to capture some of the upside from this, and you might keep some of your portfolio on a merchant basis. But if you leave too much of it unhedged and there is a downside event when the power prices drop too low and you're unable to pay out your dividends to your investors, that's far more damaging, I think, in terms of the investors and what they rely on us for that income. So it's very much a balanced approach. But I think just to touch on that is why I think a mechanism such as the CFD is a good one for infrastructure. And it's not a direct subsidy like the original projects that many of us have seen that have got the renewable obligation certificates. It's a downside protection and trades away a lot of the upside. So the government will agree a strike price, and I think and below that, if the power price falls below that, it will step in and provide a floor for investors. On the upside, all that anything above that price gets paid back to the government. So in those times, I think, I do think in the offshore wind, it's really helped to develop the offshore wind sector in the UK into a world leading sector, and we have got a huge amount of generation there. The point that doesn't often get made is that will have paid back billions into treasury coffers at the point that the power prices were super high as well, but has enabled this generation to be built and given the security for investors and lenders to lend to allow those projects to be built.
I sort of wanted to ask you a little bit more about your international strategy. I know we've spoken a lot about the UK on this podcast, but the fund also owns assets in other markets like Spain and Australia. Does your strategy differ in those markets, and are you looking to potentially expand into other countries as well?
Yeah, it does differ. I think two of the reasons we like to be places where we've got boots on the ground. So as Foresight Group, we've had offices in Spain for over a decade, and we've got a growing presence in Australia as well since we first entered that market. We've got two offices in Sydney and Melbourne, and we've got our commercial and technical teams on the ground there as well. So going through the two, because it does differ somewhat. Spain is a core market for us. It's Europe's second largest solar market after Germany, actually, but Germany is closing down its nuclear, is moving away from Russian gas. It's having to go very much all in on wind and solar and renewable generation. But we've got the local presence there through our office in Madrid, and that's led us through those local relationships to be able to do bilateral deals and get our solar investments in that space. It's also a great market where we're working with developers to develop out new solar projects and new battery projects as well. And this I think, exactly proves the case of where we're helping to grow. We've got a portfolio of operating assets, and we're bringing through a gigawatt of development. And it's a pure example of our income and growth strategy, which which we are in the process of looking to replicate in the UK as well. We are, in terms of Australia, although we've been there for quite a while, we are looking to exit that market because the fundamentals are attractive now. It is the plans the government have been talking for quite a long time about this, making Australia an energy superpower. It's a sunny place. They've got a lot of things there, but there's been a lot of. It's not without its challenges in terms of curtailment, and I think this point around, you've got a country the size of Europe with a decentralized grid now, so and that's going to take a lot of uplift, a lot of work on that as well. So that is challenges in terms of grid outages. I think in terms of that market, a lot of players coming into that because they see the potential in terms of from 2030 and beyond. We'll look to exit our projects in that market and sell them on to those that are building larger portfolios. So at the moment, our international exposure is capped, and we see a lot of opportunities here in Europe. So we're not planning to move into other markets just yet. I think we would do it through development, and we'd also like to have sort of again boots on the ground in certain locations. But other attractive markets, we do have people in Germany, so I think the German solar market is attractive if you can get there with a partner in a development play, for example.
And finally, before we let you go, I wanted to just ask you about how you measure the social value of a fund like this, because this is obviously a concern with some larger investors when they have to report back to their stakeholders. Um, they want to measure social impact, and it's something that I think more and more retail investors are also thinking about now. If I invest in a fund like this with its solar strategy, how can I be sure that I'm actually making an impact and helping to save the planet in some way? What do you guys do in that area, or how do you look to provide that reporting?
Oh, absolutely. No, and I think it's key. And we'd say from being a renewable energy generator that it's sort of, yeah, it's absolutely core to what we do, and it's inherent in everything we do in Herc. But it's a good point. How do you make that point? How do you do it? So I mean, we're fortunate. Sustainability investing is pretty core to what Foresight Group do. We have a sort of 7-person sustainability team within our infrastructure business that are dedicated sustainability professionals. So they help us look at this and stay at the forefront of our reporting in terms of through to investors as well. So you've got your sort of typical measures that I think many people have been looking at in terms of reporting for many years now, in terms of how many gigawatts of clean energy are you producing? I think we produced 530 megawatts of energy in the first half of 2024. It's enough to power 200,000 homes for a year. To put it into context, it's helped avoid 185,000 tons of CO2. So these are kind of standard metrics that are put out there to sort of compare a lot of the industry against. But you've also got a point here in terms of solar farms making an impact just beyond cutting emissions. So there's the softer side of it where we have many of our farms where we've got animals grazing. Farmers are using those to graze their sheep, for example, and that helps with a more natural vegetation management. There's nothing better than letting nature take its course in that regard. So that helps bring in revenues for farmers to manage the land and integrate those sites into the rural areas as well. And then these sites, especially solar sites, they're left comparatively undisturbed environments. And if you think about it, we've got the solar panels, we've got then all the area around them that's actually quite well protected as well for security reasons. But given that we're long-term owners and custodians of these, we're quite uniquely positioned to help contribute to the biodiversity and nature recovery of these sites. So we've actually got a partnership. Foresight Grid itself has a partnership with the Eden Project that run the site down in the southwest of England, and I also have lots of consultants who work with us on how do we push forward and improve the biodiversity on our sites. So we've done a benchmarking across the whole of the 50 sites in the UK. The nice news out of that is that we already have many sites that are offering very high levels, particularly in terms of wildflowers, butterflies, nature. There's the sort of things that, and grass meadows, the sort of things that a lot of the countryside has lost over the years. We have this free land around our sites that's a perfect place to allow these habitats to sort of rewild and regrow and add to that biodiversity. So it's to the point that we've actually Foresight's produced a document and a blueprint on how best practice in solar park management and can be used for other renewable energy projects as well, in collaboration with the Eden project, to say how particularly in the UK, but we're starting to roll this out across other international geographies, how we can make the most of this land that we are long-term custodians of.
Well, that's fantastic. Thank you very much indeed, Ross, for coming on the podcast to tell us a little bit more about the Foresight Solar Fund. That's been fascinating.
An absolute pleasure, Stuart.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news and sign up to our free newsletter there.